Welcome to the Mind Money Spectrum podcast, where your hosts, Aaron Agti and Trishul Patel, go beyond traditional finance questions to help you explore how to use your money to achieve the freedom you want in life.
In this episode, Aaron and Trishul discuss the factors employees must consider when exercising their stock options. They go into strike price, fair market value at exercise, sales price, and tax implications. They explain the difference between non-qualified stock options and incentive stock options. They also introduce leverage, the alternative minimum tax, and golden handcuffs. In the end, the decision of when to exercise options often lies on a spectrum between a sensible investment decision and a sensible tax decision, with most people falling in the gray area in the middle. And now, on to our conversation.
Hi, my name is Aaron Agti. I'm a financial advisor in the Bay Area, and I'm here with Trishul Patel, a wealth manager on the East Coast.
Hi, Aaron. Great to be here today, and thanks everybody for listening.
Great to be here as well. Today, I'm excited to talk about something near and dear to my heart, stock options. And I say that semi-facetiously, but this is something that I specifically help my clients with, and being in the Bay Area, it does come up quite a bit. So we're going to start at a high level, but start to get pretty technical. And hopefully you understand by the end of this, the decision-making process I help guide clients through when and how much to exercise when it comes to stock options. Because there's so many caveats, so many things that apply to your individual situation, your household income outside of these options, that there's no good single blanket advice. There's nothing that applies to everyone. But hopefully by listening today, if we focus on employee stock options and help you understand the framing and the factors that go into that, you can start to think for yourself, which of these apply to me and how would I take this advice and try to make that decision for myself. So again, this is not going to be a specific advice for any one listener, but a general framework of how you would come to your own decision of when to exercise stock options. So Trishul, do you mind giving us a start at a very, very high level when we talk about stock options? Kind of what's the difference between the options we can buy through an exchange and options from the employee perspective?
I'm looking forward to this conversation as well, having had to deal with options with previous employment experiences in the past. Especially as an employee, it would have been useful to have this type of conversation. So I'm very happy to have the opportunity to dig into this now with you. And frankly, I wish I had this recording back then, because it would have made my life a lot easier as I tried to decipher this before I had this investment knowledge. Let's just begin with what an option is in general. We did touch upon this way back in our discussion about volatility, but just to provide a little bit more background for this conversation, an option is just the ability to make a decision based upon a future event. So a stock option is the ability to buy a stock in the future at a designated price, that strike price or that purchase price is decided today. Now, let me just put a few quick numbers on that to provide some clarity, and that'll get the conversation going. So let's say IBM is trading at $100 today, and you buy an option, which is the right to buy that stock in the future at a strike price of $100. So what that basically says is, over a certain time period, let's call it 30 days, you have the ability to buy that option for $100. Now, why would you ever want to go into this arrangement? Well, let's say the price of IBM goes up over the next 30 days. It goes up to, let's say, $120 in a week or so. Well, you get to still buy it for $100, meaning you get that $20 differential. So that's pretty neat. That's why you would do this if you think the stock is going to go up. Now, to have this ability to buy that option, you got to pay some money up front. You got to pay what's known as the premium. And that's the cost of entering into this contract. And basically, if the stock price doesn't go up above 100 over this period, over 30 days, let's say it drops to like 90, well, then you just wouldn't exercise the option and you'd walk away losing that money you had put in, that premium. Now, to tie this into how it works with employee stock options from a company, well, there are many times where a company wants to reward their employees, and sometimes companies are in a stage where they don't have the capital necessarily to just increase salaries or give bonuses. Well, instead, they can give these options or provide these options to their employees through certain means, and there's many different flavors, which we'll get into. But basically, an employer might give or grant or allow the ability for an employee to obtain these options just like they would if they would have bought them, but they would just be giving them to them with a certain strike price in mind. So it's basically a way of transferring some sort of compensation to employees down the road. And it's a useful mechanism for technology companies and startups, as Aaron will surely dig into. But that's just the quick and dirty to get the conversation going.
Okay, so instead of the employees paying that premium that we talked about for a regular call option, that is the form of compensation. So the price of the option itself is much, much cheaper than the price of the share because the company may not go up. So that allows you to kind of buy more options than you could just shares for regular calls. Is that accurate?
Yeah, that is. So just to add a little bit more terminology, if the strike price that the option is granted at is at the current market price, we would call these options at the money. They're options that are granted at the current market price. But if the option strike price is less than the market price, these would be in the money options, meaning that there's already some value in the options to begin with. And then just on the flip side, out of the money options, meaning you have the current market price be less than the strike price. The stock has to rise to the strike price in order to be worth something. And typically when options are granted, quite common for them to maybe be out of the money, but maybe Aaron, you can provide some clarity on that.
For employee stock options, when the employer grants it, they're almost always at the money. That's the standard. Whatever the current valuation of the company is, usually through what's called a 409A valuation. That's what they use to determine current strike prices and exercise prices for options as they're granted. So they're not out of the money, but it does require this company to grow in value for the options to be worth anything. So from the employee's perspective, when you receive that grant of stock options, they're currently worth nothing. The strike price equals the fair market value of that company. You need that company to grow. So that's what the employer is trying to do. They're trying to incentivize the employees to participate and contribute to the growth of that company. And one of the big things is that unlike the call options where you go to exchange, you have to pay that premium, because that's a form of compensation, you get to participate in the growth of the company without any personal risk. That's one of the big attractive factors for options. Because they're granted to you, you get to participate in that growth without personal risk. The other big benefits are the time frame. So you talked about a call option you buy in exchange might give you 30 days. It's pretty standard that employee stock options give you a grant date or a length of about 10 years. That's the most standard time frame. And it's even possible for them to extend that depending on how well the company does over that time. So you get to participate in the growth of the company, no personal risk, and you get to wait 10 years before having to make any kind of investment decision. So that gives so much value to the employee in terms of that future growth opportunity, even though it's not worth anything at the time of grant. The other big benefit is that unlike salaries or even grants of stock or grants of RSUs, taxes and investment risk don't come into play until you decide to exercise. So on your salary, you have to pay taxes as you earn that salary. Same thing with if you receive restricted stock or as your RSUs vest, you have to pay taxes on those. With options, they can grant those to you. You get to participate in the growth of the company. You get to wait 10 years to see how it does. And you don't pay any taxes when you receive a grant of options. Those tend to be the big benefits of employee stock options over any kind of call that you would buy on an exchange. Does that make sense, Trishul?
Yeah, it does. So in that scenario where IBM is trading at 100 and an employee is given, one stock option, it's their first day on the job. The company doesn't want to be too ambitious. And let's say that stock is trading at 100 and the stock option strike price is at 100. So currently, if that employee exercised that option, he would get nothing because the strike and the market price is 0, but he has 10 years to exercise. So over the next 10 years, if the price of IBM goes up from 100 to 1,000, now all of a sudden the employee realizes, wow, it's been 10 years, I better exercise these soon. And if they do exercise that stock, they would still have to only pay that $100, but they could immediately sell it in the market for 1,000, making a $900 profit.
Okay, so here's one thing I do want to clarify. Now, I'm glad you brought this up.
Yep.
The option is still the right to buy shares. So if a company grants you options, especially if the company's already publicly traded, like IBM, so they grant the employees options at $100 per share, it's trading the market at $100 per share. If you exercise immediately, it's functionally the same thing as taking your own money, putting in a brokerage account, and buying IBM shares at $100. You've negated the benefit of the option. So you still have to put your own money in and you hold those shares. So the choice to exercise and sell don't always have to happen at the same time. And this is one of the big strategies we'll get to. But yes, if you're issued option to buy $100 and you immediately exercise, you've just bought that many shares at $100. You haven't recorded any or received any benefit from the option. So you don't owe any taxes because there was no growth, and we'll get into how the taxes work, but it's the right to buy. It still requires you putting your own money at risk when you exercise the option. So that's why I say the options that are at the money have no value, because when you put your money at risk, you could also do that outside the options and still, you could actually participate both. You could actually, if I had $100, I could keep the option and participate in that growth and put that $100 in another share of IBM in a brokerage account and also participate in that growth. So that's one of the kind of opportunity costs, that aspects that we'll talk about. Is also the idea of leverage. So we'll get into that a little bit later. But it is important that when you exercise options, that is the time you are putting your own money at risk, and you are now making that investment decision. Taxes come into play and investment risk comes into play. For some companies that are already publicly traded, you don't necessarily have to put that money at risk. You can do what's called a cashless exercise. So if it goes up to $110, you could kind of buy and immediately sell. So they don't require you to put the money in to buy. You only gain that $10 per share. So it does require you to go up, but you can't do a cashless exercise for the option that's at the money already. I think, so that's one of the things. You do have to put your own money at risk, but if you were to immediately sell anyways, you just get that same exact value back at the current market value. Does that make sense?
Yeah, so basically you want to wait until the stock is sufficiently in the money for you to sell, assuming that you want to liquidate your position and you don't feel there's any more growth.
That's one of the first things to consider. So let me go into just kind of how options work functionally, both in terms of investments and taxes. And I'll explain why that decision, that kind of first thing to consider is just waiting, comes into play. So when you are granted a stock option, I'm going to start with non-qualified stock options. So these don't have any special IRS rules or benefits. This is just kind of how options work. Because you haven't received any benefit from the employer, you don't owe any taxes. The exercise or strike price, so exercise and strike price are the same thing, they're used interchangeably, will equal the fair market value. Usually for a publicly traded company, it's the current stock price. For a private company that has not yet gone public, it's going to be the 409A valuation. So the in the money value is $0. Okay, so that's kind of, we're going to talk, the in the money value is going to be the difference between strike price and fair market value. So when you first granted, they're worth $0. There'll be a vesting schedule, usually determines when you can exercise and or sell shares. So we'll get into kind of some of the logistics around that. But in general, there will be some vesting to, again, encourage the employee to stay at that company and contribute to the growth of that company. At exercise, so this is again for non-qualified stock options, at exercise, you pay the strike price and you pay taxes. So the bargain element is the spread between the strike price and the fair market value at the time of exercise. So if that option for IBM was $100, it goes up to $120, and that's when you choose to exercise the option. You pay $100 for that share. You gain one share that's currently worth $120. And now, because you never paid taxes on the amount that the employee paid you, kind of gave you for this benefit, you owe taxes on that spread. That bargain element, that $20 between 100 and 120 is taxed as ordinary income. And because this is an employee stock option, taxes are withheld. Now, the actual logistics of how the withholdings work are kind of dependent on company plans and their stock plans. So could be that they're withholding it from your paycheck. It could be that they're forcing you to sell shares to cover the withholdings. So if you owe 20% or 25% in taxes, they might say, okay, if you had 10 shares, they're all at $100, you exercise, so you put in $1,000, you now have 10 shares worth $1,200, but they're going to force you to sell 2 of those shares for withholding. So they're forcing you to sell 20% of that to cover withholdings. Now, it's not always the case. Depends on if it's a private company or a public company, because private companies, you can't sell that shares. They might actually have you write a check to cover the withholding. So you have to both write the check for exercising the options, and you have to write the check for the withholdings. Sometimes they can withhold from your pay stub or your just regular salary. But the key is that when you exercise non-qualified stock options, the bargain element, just that spread, is taxed as ordinary income, so your regular salary rates, and taxes are withheld. So now the fair market value, so if you've paid taxes on that spread, the fair market value, so our 120, determines the date and the amount of cost basis for the shares you now hold. So if you sell immediately, then there's no additional capital gain. You've paid ordinary income on that spread, but if you were to hold those shares and they continue to grow, then the 120 represents your basis, and this date of exercise is the date. So if you were to hold it for 6 months and watch it grow from 120 to 130, then it would be a short-term capital gain, also taxed at ordinary income rates. If you were to hold it for longer than a year and it grows from 120 to 130, that $10 on top will be taxed at long-term capital gains. So if you were to do, again, that cashless exercise, that will be a way where you don't need to write the check to fund the purchasing of the options. So what they're going to do now is sell enough shares to cover the exercise price. And so you only result in enough shares to cover the, what was that spread? So if you, in our example, IBM will start at, have an option strike price of $100. Again, we're going to say you have 10 shares, you have 10 options, goes up to 120. That's when you decide to exercise. But if you do a cashless exercise, they're going to sell enough shares at 120 to cover that $1,000 exercise. So they're going to sell 9 of your 10 shares to generate, what's 120 times 9? Real quick.
1,080.
There, thank you very much. They're going to sell 9 of those shares, generated $1,080. 1,000 of it went to funding the purchase. You get a check worth $80, and you still have 1 share left over that has a basis of 120. So because that cashless exercise happens at the exact same time, there's no capital gains, but also we didn't factor in your withholdings. So you can do a cashless exercise, but you want to be kind of aware it's going to come out of that spread. So you still have to pay the exercise, you still have some value, but your spread, once you account for taxes, the kind of the amount that you have is not as much as you think. You don't have 10 shares at 120. You have 10 shares that have grown by $20. So it's like $200, and you owe taxes on that $200. So that's one of the things to keep in mind when looking at options, is focusing on that spread, that bargain element, and not just the share value. And then if you're to hold on to it, then capital gains taxes come into play. But if you were to sell immediately, there's no additional capital gains tax. It's okay to exercise and sell immediately. You'll owe ordinary income, but you're going to owe that anyways, just upon the exercise. So that would be a way where if you have non-qualified stock options, it's fairly common to exercise, sell immediately. So especially if you do a cashless exercise. So in this case, you're just going to get your $200 minus withholdings, and you could reinvest that somewhere else. So you've already participated in that growth. You gain $200, and you're going to invest that money somewhere else. So it's a way you already have enough company stock. That's where you work. That's where your salary comes from. If you want to diversify, reduce the risk, you could invest somewhere else if you wanted. So we're able to follow all that for non-qualified stock options. So again, the fair market value at exercise is going to be one of those key values and dates. It determines that spread, the bargain element between your strike price and your fair market value. That's going to be taxed as ordinary income. If you sell immediately, there's no additional taxes. If you were to hold on to it, any growth or loss, because it could go down, is a capital gain or capital loss. So you got all that, Trishul?
Yeah, that kind of makes sense. So as a employee, I think what might be going through my mind is there seems like a few competing concerns here. One is a simple check where you probably don't want to exercise if your stock is not in the money.
Definitely.
And then the second thing you may want to think about is you're going to have a tax event coming up with a non-qualified stock option when you exercise. And if it's a public company, you may be able to absorb some of those taxes, like you said, by having the stock be sold and then use that to cover the tax burden. Or you can have the tax burden come out of your paycheck, so that there are things to do to soften that blow. But it sounds like if it's a private company, then things may get a little tricky, because that stock may not be able to be even sold when you exercise. You might be kind of stuck with it, but you would still have a tax burden in addition to the exercise price to worry about. So it seems like that's a concern. And the other thing it seems like there's a concern is if you wait to exercise, then it seems like there would be a concern there as well, because then the stock price could just keep going up, and now you're going to owe ordinary income tax on a higher stock price. So it seems like that's another competing concern to think about.
Yes, both of those are accurate and great ways of phrasing it. So again, one for private companies, for non-qualified stock options, because you can't sell any shares to cover either the exercise price or the taxes owed on that action, it is less common to see people exercising non-qualified stock options for a private company, because you have to be willing to put your own money at risk and you owe taxes at the time of that exercise. So that's why it's less common. It's not, we'll get into some of the caveats and situations where it might make sense, but that's just one very rough rule of thumb. The other thing we talked about is, yes, if the stock price goes up dramatically, you're going to increase the amount of money that you owe in taxes, and also increase dramatically. One thing I always point out to clients, if the stock is going up, your tax bill is going to get higher, you're always going to net out more. You're always better off if your investments go up and you pay more in taxes than seeing them down and trying to save on taxes. You're always better off in the long run, both in terms of just actual dollars, but net worth growth of seeing that stock go up. So it's okay to see that go up. The other thing this kind of points out is stock options and a lot of the analysis at each individual tends to be on a spectrum between tax and investment risk. And what I mean there is, some of the times the best decision for taxes actually involves the most investment risk. Whereas if you want to go to the other end and take on the least investment risk, it's usually just not exercising anything and just waiting, so it didn't cost you anything, that's when it's going to be the highest tax burden. And that'll come up a few times of, if you imagine that spectrum between good tax decision and good investment decision, and finding some gray area in the middle that applies to you, that ends up being the case for most individuals. That some people, again, they're employees at a company, they're not professional investors, they don't like taking on that investment risk. So they just hold the option, doesn't cost them anything. They would see what the company does. They, as soon as they can sell, so if there's an IPO, they wait 6 months, they sell out of everything. They've gotten their windfall, they pay all their taxes, but they never took on any investment risk. Whereas at the other end, if there's kind of enough planning and foresight and they understand the risks that they're taking on from an investment perspective, they can reduce their tax bill by quite a bit. And this is a personal decision. I have clients at both ends of the spectrum. Sometimes I have to kind of bring them back from the edge of saying, no, it's okay to do nothing at this stage. We've done the analysis and we're consciously not doing anything this calendar year. This is a conversation I do have with some clients, and others like, okay, no, we got to get this done before December 31st. We'll be talking in December, like, no, we got to figure this out because we're going to lose this calendar year and we want to take advantage of that. So it does apply, but that'll come up a decent amount where, yes, if the investments do really, really well and you haven't exercised them, you're going to pay a huge tax bill. And that's a good thing. You took on no investment risk and you benefited by the growth of that company. Does that make sense?
It does make sense. And I think a good part of that investment risk that I see is that there's a good amount of concentration risk there. And the notion there is, when you do investments in general, you want to have a good diversified portfolio. You don't want to put too many eggs in one basket. But if you're an employee at a company, well, thing one, you have your paycheck tied to that company. And then thing two, if you end up owning a lot of stock in that same company, now you have a good amount of your net worth in that company as well. And that's just something to think about in terms of concentration risk.
Yes. And this is another thing that kind of falls on that spectrum. It's the concentration risk is high risk, high reward. That if you can tolerate that risk and see it go to zero, then the upside is going to be dramatically higher. The more conservative strategy is having a diversified portfolio and diversifying kind of as much as you can. So not only across multiple stocks, multiple asset classes, even diversifying away from your investments are growing differently than your income grows. All of these are ways to diversify, but it is reducing your potential reward as well. This is one of the things I've seen, especially in the Bay Area. Some employees at companies that have IPOs, and if they did not follow the prudent conservative advice, they end up with a greater net worth. But other employees that 5 years ago were in the exact same situation started another startup, and that company didn't go public, that they have nothing. So that's why I say it is a truly high risk, high reward, sometimes on the scale of millions of dollars, but it is a choice that individuals can make. Sometimes if they're saving enough in their 401k to cover retirement, if they are saving enough separately to get a down payment for a house, and they've working towards all of the other long-term lifestyle goals, then it can be okay to take on that risk. But kind of we talked about this other time, we don't want to bet retirement on this one stock. Doesn't matter any company, much less your employer. But for the same reason we don't put all of your investment dollars in one single stock or even just a small handful of stocks, we diversify across a broad asset allocation. If you need this money for retirement, I tend to push towards divesting that single stock. But if you didn't necessarily need that money for retirement, then sometimes it's okay to hold on to that concentration risk. I forget, I was at a conference listening to someone speak on stock options. They talked about concentration is not an evil to be stamped out. It's a high risk to be understood. So I do try to make sure to educate my clients on concentration and the risks and entails versus diversifying. So do you have any kind of additional thoughts on that, kind of the spectrum between high risk, high reward of concentration and lower risk, lower reward of diversification?
I like the way you kind of put that. And I think the main point is it just comes down to the individual. What does the individual feel like they can tolerate, and what does the individual think is sensible for this situation? So yeah, good stuff. And I like the way you said that, Aaron.
Okay, thank you. So the next thing we'll move on to is ISOs, incentive stock options. And I'm going to there's lots of benefits here, and I'm going to try to explain them and explain the rules. And I'm letting you know there's a big but coming after this. So don't get too excited all at once. The big difference between non-qualified stock options and ISOs, if you follow all of the IRS rules for ISOs, is that unlike non-qualified stock options, so remember we talked about how the bargain element, that spread between the strike price and the fair market value at time of exercise, is taxed at ordinary income. With ISOs, that bargain element is taxed at preferred long-term capital gains rates. So depending on your tax bracket, you could be saving somewhere between 5 and 20% of the value of that spread by just paying long-term capital gains rates instead of ordinary income rates. So that's the first big benefit of ISOs. The second big benefit is that where non-qualified stock options, you have to have taxes withheld and you owe taxes at time of exercise. With ISOs, there's no taxes due at time of exercise, only when the shares are sold. So we've now introduced these kind of two-pronged benefit that if you can follow the rules for ISOs, one, you can save up to 20% of that value, and two, you don't have to pay taxes now. You don't have to pay taxes until you sell the shares in the future. You can push off that tax burden. And like what we talked about, if the company's private, that could be a big deal. That if you were to exercise ISOs and you can't sell the shares to pay for the exercise or especially the taxes, then ISOs where you get to defer the taxes until you sell the shares, that is a big benefit because you know you don't owe the taxes until you have the money to pay for those taxes from that action. So those are the big difference between non-qualified stock options and ISOs. So do you have any quick questions on those two factors and what comes to mind when you hear that?
Yeah, so in the situation of an ISO, why wouldn't you exercise if you're in the money?
Okay, so we'll get into that, but that I'm going to push that. That's leading to the big button. I'll come to that in just a second, because I want to explain the rules for ISOs that you have to follow. So with ISOs, the main rules, and we'll get into a few of these, but the main rules are you have to hold the ISO 2 years from grant date and 1 year from exercise date. So you're granted ISOs, you have to usually wait a year for the first vesting anyways, and then you exercise and you have to hold those shares for another year before you can sell them. So the first thing that comes up is that you have to pay for the exercise out of pocket. You can't do a cashless exercise for ISOs. Now, if you can hold it for 1 year after exercise, then it's a qualifying disposition. You have qualified for all the IRS rules and you get to sell those shares and get long-term capital gains rates, and you owe taxes at the time of sale. If you were to sell it within that 1 year, if you're not able to hold it for a year, it's called a disqualifying disposition, and you no longer get ISO benefits, it goes back to all of the non-qualified stock option rules. So one of the first things that comes up to answer your question is that you can't do a cashless exercise. So you have to have the money out of pocket to pay for those ISO shares. So that would be one reason why you might not exercise ISOs even if they're in the money. So that's the first one. Other rules that come up is that they are only for W-2 employees. It means they are not for contractors, they're not for others, individuals that don't satisfy that rule, but they have to be for W-2 employees, which means if you're terminated, either of your own choice or the company's choice, you now have to exercise those ISOs within 90 days to maintain the ISO status. Again, this is going to be company specific. There are some companies where based on their plan, if you leave the company, you lose those options after 90 days. If you don't exercise 90 days, you lose the options completely. There are other companies that will allow you to keep the option, but if you don't exercise in that 90 days, it's no longer eligible for the ISO status. So you might be able to keep that option for the 10-year expiration, but it's going to be a non-qualified stock option. And again, this is very company specific, so you need to check your company's plan. Either way, you can't keep ISOs if you're no longer an employee. You have 90 days to exercise or you lose the ISO. Some companies say you lose the option completely. Other companies say, no, you can keep the option, but it's no longer an ISO. It's going to be a non-qualified stock option. Other smaller rules, you can't have more than $100,000 of ISOs vesting in a calendar year for each individual. So this is based on strike price and vesting schedule. So any excess above that $100,000 per year per individual is treated as a non-qualified stock option. So sometimes you'll see either higher executives or earlier employees, it's possible that they do have values of over $100,000 vesting. So can't do it over $100,000. If you sell it prior to being held for 1 year, it's treated as a non-qualified stock option. So again, it's a disqualifying disposition. And here's the big but. Here's the big caveat that comes into play. I said that when you sell ISOs, you don't owe taxes at time of exercise, and you don't have taxes withheld. But the bargain element, that spread between strike price and fair market value, the bargain element of ISOs is an AMT preference item. It's an alternative minimum tax preference item. So even though exercising ISOs is not normally a taxable event, the spread is included in the AMT calculation. And this is where I immediately tell our client, we're going to talk to your CPA. We're going to consult a tax professional. This is the area that's most likely to cause problems and is unique to each individual household. Your salary and your spouse's salary and your household deductions all come into play here. And sometimes people need a primer on just how AMT works. Sometimes it's a little issue, sometimes it's a big issue, but it does come into play every single time. So here with regular taxes, there's a normal 1040 calculation, almost completely independent that there's a AMT calculation. So the AMT is kind of independent. It adds certain deductions back in, counts income slightly differently, but it's a parallel calculation, and you owe whichever is higher between the two. And if your AMT calculation says you owe $50,000 in taxes and your regular tax says you owe $40,000 in taxes, then that difference, that $10,000 is considered your AMT. That's what the actual alternative minimum tax was that extra $10,000 you pay in taxes. So when you have situations where you held off on selling the ISOs because you didn't want to take the investment risk and you build up a large spread, then you might be exercising those ISO shares, choosing not to sell them because you want to hold them for 1 year. So now you have a situation where it costs money out of pocket for the exercise, and that AMT tax bill can be pretty prohibitive. This does kind of, when we go back to think about some of the other caveats, if you were terminated and you're trying to exercise all of your ISOs, that adds all of that spread to your AMT. You don't have the cash to pay for it. And this comes into play where sometimes if the company has done well, you might have a tax bill of a few $100,000 and you don't have a few $100,000 lying around to pay that tax bill. Now, if the value of the stock stays the same and you can sell it a year later, you'll have that cash a year later. But paying that AMT bill ends up being the other big reason why employees might not exercise ISOs. That there has to be specific planning for how do I balance this investment risk and this tax situation, because the AMT tends to be a big problem. Under old tax laws, it was pretty consistent that anyone exercising ISOs was going to be pushed into AMT. Under the new Tax Cut and Jobs Act, they raised some of the ISOs available to you. So now it's possible where your regular calculation is a little higher, your AMT calculation is lower, there might be some kind of spread you could add to your AMT income via exercising ISOs where you don't go into AMT. Again, it's going to be dependent on each individual household, consult your tax professional, but that ends up being the big problem. So Trishul, after I kind of gave those rules and the big caveat when it comes to AMT, what are some of the things going through your head now?
Great explanation, Aaron. It seems like there's, again, a good amount of competing concerns here that one might need to think about. What's kind of going through my head in this scenario with incentive stock options is that here you might have a competing concern of if you wait too long to exercise and the amount of value your stocks contain keeps going up, now you may have this strong AMT concern to think about. Whereas if you realize this early on and you have this, for example, vesting schedule where you get another 20% each year and so on, you may want to start exercising earlier so that you can maybe control that AMT burden. Instead of having one big burden at one given time, you may be able to spread out your burden over many years so that you could potentially mitigate that AMT concern. That seems like what's going through my mind. But then the other concern that's going through my mind is, well, let's say you do exercise and you have that 1 year holding period. It could very well happen where you buy IBM for 100 or at your strike price of 100. It's currently trading at 120, and you diligently wait a year, but whoops, a year later, IBM's down to 80, and you're kind of stuck now with a stock that is currently eligible for long-term capital gains, but here you go, it's lost money.
Yeah, in that situation, you get the worst of both sides where you still owe AMT on that 120, on that $20 spread. You actually you have to track your AMT basis definitely than your regular basis, and it gets getting really complicated really fast. But yeah, you could be in a situation where you owe taxes even though you've lost money.
Yes.
And that's it happens. You have to kind of plan for that scenario and understand that's where we're talking about the balance between investments and tax risk. So you kind of hit on one of the, I don't want to say common strategies, but a possible strategy when it does come to exercising ISOs is to consider exercising ISOs when they vest. This is likely already 1 year from the grant date. The vast majority of vesting schedules start at 1 year. And then it starts that 12-month clock to be able to sell. And if this company keeps going up, the value keeps going up, then this kind of minimizes the spread. So if you exercise earlier, the spread is lower, so it's least likely to affect AMT. Then for a publicly traded company, you could even get on this kind of schedule of if you exercise early in the year, so let's say exercise in January, wait until December, you can kind of, you have 11 months worth of information. Do you sell in December and create that disqualifying disposition? So it's no longer an ISO. It's back to non-qualified stock options rules. So there's no AMT concern, but you are adding to your regular tax bill. So you can kind of see how that goes. Or you wait 1 extra month to go back to January and you sell ISOs. You've achieved the 12-month holding rules to qualify for all the ISO benefits. You get the long-term capital gains. You owe the taxes that year. But now you also might have some of the cash to pay that AMT tax bill that you're going to owe spring of the following year or spring of the year you sold, because the AMT bill is based on the action last January. And then you also have a little extra cash to fund the next exercise. So you could get onto the schedule of exercising and selling every January to make sure that you have the proceeds to cover the tax bill, and then you also have the proceeds to cover the exercise, and you've still held that 12-month. So that's one of the strategies with ISOs, especially for publicly traded companies. However, this costs money out of pocket, and you are giving up some of the best benefits of options in general. Those being specifically, again, there's no personal assets or capital at risk. The money that you could put in that option, you could invest in the same company or in anywhere else you wanted. You could have both of those growing at the same time. So that'd be a way to have double the amount of money that you have for investment growth, and you lose out on leverage. And so this comes into play with all stock options, and it's the idea that kind of applying the math where letting the option grow without putting money in allows you to actually increase your rate of return. I'll try and give an example of some basic math. If the share price is currently $2, okay, just keep the math easy, and you have an exercise price of $1, okay, so if you go out and you buy that stock at $2 and you're going to wait a certain amount of time. Or you have that option through your employer to buy that stock at $1. It's the same math that works for regular call options on exchange. But if the $2 stock goes to $3, you saw a 50% growth in your equity. But with an option, again, you had the right to buy it at $1. Going from 2 to 3 has increased your spread from $1 to $2. So that 50% growth on the equity of the share class, of the share price, was a 100% growth of the equity if you hold the option. And this ends up being one of the bigger benefits and reasons to hold an option from an investment perspective that encourages you not to exercise. Now, it's again kind of making a lesser tax decision, but this might be a way to increase your net worth more effectively, especially early on. So early on, you might be thinking, I'm going to exercise my options because the spread's really low and I want to fit it under the AMT, or it doesn't cost me very much, but you're losing out on that leverage. Now, later on, so let's say we have that same $1 strike price, but now the stock is worth $10. If it grows from $10 to $12, that's a 20% growth in the equity. But if you have the option, your equity was $9. Again, $10 share price minus your $1 exercise, and it grows to, the share price grows to 12, but your equity again is only 11. So again, 12 minus 1. Your equity with the option went from $9 to $11. That's only a 22% growth of the equity. So now when the vast majority of the share price is equity already compared to the option value, then you lose some of that leverage benefits. There's always going to be some, but it's going to be a lot less. So this would be a time where, okay, there's less leverage benefit. Maybe I exercise now, but again, the share price has gone up to $10, and you now have to consider the spread as it applies to both taxes and AMT. So do you understand the explanation of my examples of leverage when it comes to options and why you might want to hold the option instead of exercising?
Yeah, that's a good way of putting it. It comes down to the notion of an option is kind of, as the name implies, it's the ability to do something if it makes sense. So if it makes sense, you can go ahead and do that, but you don't need to take that risk unless you think it's really worth it. And you can wait, as you said, sometimes 10 years.
Yeah. It gives you more time to wait to see, is the company actually going to pay off? We talked a little about kind of public versus private a little bit. For public, that strategy I mentioned would work earlier. For private companies, you can't sell the shares. So this becomes, if you were to exercise the ISO of a private company, while this might be the best tax decision, it's probably taking on the most investment risk. And so it actually might make more sense to not exercise the ISO, or at least finding that gray area, maybe exercising a little bit of ISOs over time as the company's growing. Again, consult your tax professional, calculate how much you could exercise without going into AMT. Like those are factors that come into play. So that is one of the strategies I see. Also, if there's a lot of leverage to be gained, that tends to imply that private company may not be particularly close to going public or having a liquidity event. So again, this is lots of random guessing, and I'm not a venture capitalist. I'm not an expert on growth of private companies, but it's just a very, very roughly, if the 409A valuation is close to the exercise price, then there's a lot of investment risk. You have to be willing to lose any money that you put into exercising these options. You have to be assuming that the chance that this company goes to zero still exists. So maybe if it can hold on to it for a little longer, but exercising ISOs does reduce kind of that future tax aspect. And as you get closer to the liquidity event, it can provide some flexibility, especially if you can sell, then you don't need to hold the shares for 12 months. You can sell early, create that disqualifying disposition. When it comes to things like IPO, you want to compare the timing pre-IPO, that's include that 6-month lockup, and when you can hold the ISOs for 12 months. So you might see if there's an announced IPO date, then some employees will start exercising ISOs so that when they get to that 6-month period, they've established that 12-month holding period for ISOs. That's one thing that comes up. Your personal time frame is another big one. So because ISOs are only for employees, if you think there's a chance you might take a job somewhere else, then you'll have 3 months to exercise the vested ISOs or you lose them. And again, exercising all the ISOs at the same time will be even more expensive when it comes to AMT. And this is a phrase called Golden Handcuffs, where, yeah, you got a lot of money in these ISOs, but you can't leave the company because you can't pay the AMT bill. So there are some other options that are introduce a lot of other risks. You can use a company like ESO fund, which will help pay for it, but they're going to take a lot of the percentage of the gain. This might be a situation where exercising a little bit of the ISOs each year along the way means that if you were to leave the company, you don't lose those ISOs. So you're not suffering from that golden handcuff situation. Again, you got to really consider how much of your portfolio is in a single stock. That's that concentration risk. How much of your net worth do you want in that? And especially the company that's paying your salary, there's a lot of kind of caveats and things to consider as we look at when to exercise stock options and specifically ISOs. So I have a few others I want to get to, but do you have any questions or any thoughts that come to mind based on what I just mentioned?
I think it definitely shows that there are a lot of things to consider, and it's not a simple X, Y, and Z solution for anybody. It seems like you really have to think things out and actually think about how you feel about things and design a strategy that makes sense for yourself.
Yeah. Other things that come into play, I do want to kind of make sure to mention, can't early exercise ISOs before they vest. You still have to hold it 2 years from grant date, 1 year from exercise to get the ISO benefits. But if it's a later tranche, so it's the amount that's going to vest on that second year, you could do an early exercise after 1 year so that that particular tranche is achieving 2 years from grant date, 1 year from exercise, all at the same time that it vests, to be able to sell that all at once and still maintain that ISO status. So it starts that 12-month clock before the sale earlier. You might have a smaller spread on AMT, so it also kind of helps mitigate that golden handcuff situation. You have to file an 83B election. Most companies help file this, but you're specifically saying you're exercising these options before they vest and you want to maintain the ISO status. So you do have to file that 83B. Most companies help with that. A very rough rule of thumb for non-qualified stock options might be to just wait until you're ready to sell before you exercise. So again, you're going to pay that ordinary income taxes either way. Let's see if the company goes up high, and then we'll pay the taxes there. It also allows you to do a cashless exercise, so you don't have to put money out of pocket. You can also have enough proceeds to cover the taxes. We talked about kind of each grant in isolation, but it's pretty common to have multiple grants over time. And so one of those gray areas might selling some non-qualified stock options, using those proceeds to pay for the exercise of the ISOs. And then you also might have enough for the taxes. I helped a client recently. He had a lot of ISOs. We figured out, okay, we need to sell and we need to exercise and sell this many immediately because that's going to increase our regular tax and it's going to provide enough cash to fund the exercise of all the other ISOs and fund the AMT bill and still have some cash left over for personal things like paying off a loan. So that was just one of those middle grounds. You don't have to do all or nothing. You can use a disqualifying disposition for some of the ISOs, but not all of them. And you kind of find that middle ground between taxes and investment risk and how to balance that. Look at your income from one year to the next. If you can predict, oh, I think I might be in a different tax situation the following year, how does that come into play with exercises? So if a spouse is going on maternity or paternity leave and their income might be lower, if they're starting a new business, if they're going to take a sabbatical, there are different reasons to try and predict where your tax situation might be. That provides opportunities of strategically exercising one year or the other. It requires planning in advance. I think another caveat that does come into play unusually, but I like to make sure everyone's aware of it, is something called QSBS. It's Qualified Small Business Stock. This is a potential opportunity that if the company is smaller than $50 million, if the valuation of the total company is less than $50 million, there are a lot of other rules to look into it. But if you own shares, or you buy shares of a company that's worth less than $50 million, you hold them for 5 years, it's potentially up to $10 million completely tax-free, meaning there's no capital gains taxes. There's a lot of other rules to follow, and but one of the big things is that you have to own shares of that company, not options. And so that potential benefit of having all the gain be tax-free, again, a lot of other rules related to QSBS, the Qualified Small Business Stock. That might be a reason to exercise options early and just take on that investment risk. Usually this only applies to people very early in the company, maybe founders of the first dozen employees or so, where the strike price is probably under $1, so it might only be cents per share. But that's a situation that could come up where it would make sense to exercise the options and not take on the leverage, or not try to benefit from the leverage of options if it can qualify for QSBS. So that's one thing I tend to ask any employee. I have options to look and exercise. Just like, is the company worth more or less than $50 million? Oh, it's worth more. Okay, then we'll go on down another path. But if it's less, okay, we strongly want to consider exercising now, and here's why. But it's so far away from liquidity that the investment risk is probably at its highest. You've given up the benefit of leverage, it costs money out of pocket, and that company is still likely to fail. So understanding that, and not everyone's willing to take on that risk, but that's one of those high risk, high reward situations of the benefits of QSBS could pay off down the road. So I know today was a longer conversation than we usually have, but this was a lot of really good stuff. Do you want to add anything, Trishul? What comes to mind with all those little caveats that I said? Anything that you wanted to ask me about or want me to clarify on?
You've provided a great overview of all the nuances involved, and clearly showing that it's not as simple as it sounds. Well, one thing that went through my mind is, so why would a company want to go with a NQSO or an ISO to begin with? What's driving that decision?
That's a good question. That's a corporate accounting question that's just a little bit out of my expertise. It usually comes down to how they're compensating employees. You usually see a transition point. So that, remember we talked about that you can't have more than $100,000 of ISOs vest in a single year, or else to become non-qualified stock options. So if you're trying to design a compensation structure for all the employees, and you have this certain structure of this level of employee makes this, their superior makes a little bit more, superior makes a little more. So like at each level, you might get in a situation where the kind of fairly compensate the lowest level of people you're trying to attract because you want to give them options. then you're pushing that back up the scale, and all of a sudden you have certain executives or founders or early employees that are getting so many more ISOs. So if the company has grown, it's up around that $10 share price, then it might be harder from a corporate accounting perspective. So that's why they'd rather just do non-qualified stock options. Again, I'm not an expert on this part, but it's I would say kind of common schedule is ISOs early, maybe super early, non-qualified stock options still in a private stage, but no liquidity event on the horizon. As we get closer to an IPO or liquidity event, they're actually probably more likely to offer RSUs where there's enough value in the restricted stock units. So that's a conversation for a different day of both comparing RSUs to options, but also how do you plan around that? And then the RSUs for publicly traded companies. That's a little more common, but there's enough other corporate accounting situations that come up into play of why they would offer ISOs versus non-qualified.
Thanks, Aaron. It looks like we covered a lot of ground today, and I'm glad we had a chance to have this conversation. And like I said before, this certainly would have been helpful for me many years ago when I had to actually digest this and make important decisions. So I'm hoping this will be a pretty good resource for somebody who just wants to understand what their stock options are all about.
I'm really glad that you found this to be helpful, and maybe in your next life that you'll have this awareness and make the decision that's right for you. And it's possible you did, but now you'll do it intentionally.
Yeah, without having to pull my hair out, for sure.
Yeah, exactly. I'll make sure I've written up a longer blog piece that tries to talk about all these caveats, so I'll add that to the show notes as well. You can also email me if you have any questions about employee stock options.
Good stuff. Well, thanks, Aaron. I appreciate the conversation, and thanks everybody for listening.
Thank you as well, Trishul. I really appreciated your time today.
Okay, bye.
Bye. We appreciate you joining us today for this episode of the Mind Money Spectrum podcast. Be sure to visit mindmoneyspectrum.com to access the entire library of episodes. Remember, it's not black and white, but the wide spectrum of gray area where you get to pursue the freedoms you want in life. Opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and has no guarantee of future results. All indices are unmanaged and may not be invested in directly. Have a nice day.